You're listening to the Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? This is Mike from the Moose on the Loose. I hope you are doing well. Welcome to this best in class per sector part number 3. Today we are going to talk mostly about industrial picks because there are a lot of interesting companies in this sector. It's kind of ironic because when we're thinking about the Canadian market, we're thinking about pipelines or other oil and gas related stocks, natural resources such as like gold mining stocks maybe, and then financials, right? Life insurance, Canadian banks, the usual. Some utilities also maybe, but we often forget that we do have amazing industrial companies. And one other thing that I really like about this sector is you could easily have a 30% exposure to this sector and still be well diversified throughout many different industries. Today, we're going to talk about heavy equipments, railroads, engineering firms, information services, subscription-based model, transportation, trucking, selling like hardware piece for kitchens and cabinets, waste management. So you can see that there's like the list is very, very long in the industrial sector. And let's be honest, I don't think that there's a big link between selling cabinet hardware with railroad transportation, right? So let's start with the railroads, Canadian National Railway, CNR, and Canadian Pacific, Kansas City, so CP. Those are two amazing railroad companies. I'm getting often asked which one I prefer, so I usually go with whatever dividend triangle is stronger. So for those two railroads, the choice is obvious. CNR, mostly because this one is increasing its dividend every single year, while Canadian Pacific is not. So both companies are great. I'm pretty convinced that you will make money holding them for a very long term because there's not really a replacement for railroads and there's not really competition for them. So they're both in a duopoly in Canada, basically. So I don't see major threat, but I will just go with the dividend grower, but definitely two great investments. Another duo here, you have Finning International and Toromont Industries, so FTT and TIH. Finning International is, of course, more on an international play for selling and renting heavy equipment, while Toromont Industries is more based in North America. They are both large Caterpillar dealerships. They offer other services as well, but that's the bulk of their business. They are cyclical, of course. But because whenever there's a slowdown in the mining business or in the construction business, they will suffer from that too. But overall, they are very, very solid businesses. Toromont Industries is showing a stellar dividend growth history with more than 30 years of consecutive dividend increase. Of course, I do have it in my portfolio, full disclaimer, and I do have Canadian National Railway. So you can imagine that I just focus once again on dividend growers. Big surprise here, but I do like both stocks. It's just that Finning International takes a pause sometimes from their dividend growth policy. Moving on to the trucking business, TFI International. I just did an episode on this one not too long ago. I really like their growth by acquisition business model. More than 80 acquisitions since 2015. They have a pretty clear playbook. They are making a lot of money by doing this. They are evolving in a highly fragmented market. So whenever there is a recession, they benefit from their size to acquire smaller competitors and make more money moving forward. So kind of interesting. Thomson Reuters, another one that was on the Moose on the Loose not too long ago, TRI. So selling subscription-based information services to law firms, to accounting firms, and other corporations. All about recurring revenue, very, very stable business model. Maybe a lack of growth going forward. But in the meantime, as they specialize in complex information and they have like a very sticky business model that goes with subscription, I think they're going to continue to be stable for a very, very long time. Another one on the list, Waste Connection, WCN. Of course, taking care of waste management. This one you'll have to open your checkbook because the price will be steep, trading at a very high valuation, but it is pretty much the play here. They always trade at a very high price for two reasons. They have a very solid, sticky business model. It's like basically recurring with municipalities, so super interesting business model. And on the other side, they grow high single to double digit year over year. So they kind of set that expectation of high quality company that must trade at a pretty steep price. Another play interesting that is Stantec, if you want to make a play on spending in infrastructure. So it's an engineering firm. And one thing that is super interesting about this one is they go from the plans, from managing projects, all the way down to getting rid of assets. So decommissioning an asset. So they are able to assist anyone at any stage as long as you need an engineer somewhere. This is really great. They grew by acquisition. They show a very strong dividend triangle. It's actually how it got my attention. I pulled it off from the DSR Rockstar list. So it's a list of stocks tracking all Canadian and US stocks and pulling out only companies with a positive dividend triangle. So revenue, earnings, and dividend growth over the past 5 years must be positive. You can also start your research too by downloading it at moosemarkets.com/rockstars. So moosemarkets.com/rockstars. It's a free list. You just enter your email and every month you're going to receive an updated list with new metrics, which is kind of cool, right? So a great starting point for your research. I had a few more on that list for the industrial, but I quickly want to talk about the technology sector for a second. So technology sector, not a big sector in Canada, and definitely since Shopify went down, it's not paying dividend, but it's quite limited. In terms of dividend grower, I don't have one stock that I really, really like. There's OpenText, but they lack of growth as of late. There is Texas, but it is a small cap. Kind of like the company, but the fact that it's a small cap and it still has to invest massively in their growth before they generate higher earnings, it's kind of tough as well. So the only play I have in the Canadian turf is Constellation Software, which is ironically not a dividend grower, but it does show a perfect dividend triangle besides the dividend growth policy. So revenue is increasing almost year over year. The earnings per share is quite positive. The operating cash flow, always trending up. And they have not that much debt for a business that is a serial acquirer. So they grow by acquisition, but they're buying small companies in niche verticals in the software businesses. And they go there with their reputation and their playbook, and they help managers to boost the business to another level. They've been doing that for a very long time with high rate of success, and they keep on rolling. The stock price is now $4,000, which is kind of crazy. But I mean, you can invest in one or two shares and still going to make it, right? It doesn't really matter. What matters is how much you put in dollars, not necessarily how many shares you own. But Constellation Software, it took me a while before getting convinced, but I finally jumped on board about 2 years ago, and I'm super happy about the results, of course, and it is a fascinating company to follow. So, all right, Moose, I'm running out of time. Too many companies today. I hope that you had taken some notes and then you're going to start digging. If you want more ideas like this, you can download the Rockstar list at moosemarkets.com/rockstars, moosemarkets.com/rockstars. And of course, don't forget, we are not going to have a show on Thursday and Friday, but I am coming back with a full schedule next Monday on the 22nd. I'm finishing my trip to Iceland right now. So definitely my next Business Friday will actually probably be a trip Friday, so a travel Friday instead of a Business Friday. I'm going to tell you more about what I did and what I enjoyed the most. Until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.